Can you sell the market here? When we were at this price yesterday, we had a big bull bar and they sold it. I wouldn't do it. This is a reversal, a sell-off and a reversal up. So to sell, I think the bears will need a pretty good sell signal bar. Yesterday had a big gap down and then a sell-off on a bear channel. And then it was sideways for the remainder of the day. Tremendous volume at the end of the day. Bar 78 is the final bar of the day. And it had close to, I had about 190,000 contracts traded. Bar 78 always has the most volume of the day. But yesterday was also the last day of the month. So that's the reason for extra volume. And the monthly chart, I think, is very important because look what October ended up being, a bear reversal day closing on its low. So we're going to trade below the October low. We might do it today. We might do it sometime next week. But we're going to trade below the October low. And we're at the top of a channel. Different ways to draw it. You can draw it using this high and that high, or this high and that high. And the market tried to get a double top here. Instead, we got a breakout. And the breakout has three legs up. One pullback, two pullback, three. So when the market repeatedly tries to pull back, after you've had two or three reversals, you tend to get a bigger pullback, lasting a couple legs down. So October is probably going to be the high for the next 2 or 3 months at a minimum. And how far down do we go? Well, we tested this breakout point, the post-pandemic rally. We tested that here. I think that's a logical area to test. Also, we have a breakout, a spike up, a pullback, and a channel. The market tends to come down to where the channel began, which is also in that area. So that's about a 10% correction. Weekly chart, same thing. Here's the rally after the pandemic. And the market tried to remain in a trading range. Instead, we broke out here. And we have three legs up, one pullback, two pullback, three. And when you have three legs up, it's a wedge, and you typically get a couple legs down. A couple legs down on the weekly chart. It could be like this. Here we got three legs down, lasted a couple months. So we're probably in the beginning of a pullback, and you always look at prior lows. Bull trend needs higher lows, higher lows, higher lows, higher lows, higher lows. And when you get a pullback, the market tends to generate confusion. And one way to do that is to go below a prior higher low. If it goes below a prior low, prior higher low like this, you got a bull trend, higher low, you went below it. Traders wonder, are we going to correct? Or are we going to go sideways? It increases the chances that the bull trend has ended temporarily. So I think the market needs to test this low. And the weekly chart does not look like a very good top. We don't have a good sell signal bar here, but we do have three legs up. And I said this was a breakout. And whenever the market breaks out, you always look at what it broke out of. It broke out of this high. It broke out of that high. And then you look for measured moves. If you look for a measured move up, the rally started here. Here was the breakout point, and we got very close to the breakout point, which is around 59.50 or so. And I said that that's the neighborhood where we might get the end of this rally and pull back down to these lows in the 5,000 area. The weekly chart, as I said, that's not a good sell signal bar, but the monthly chart has a very good sell signal bar. So it definitely looks like a credible start to a pullback down to this area, the 5,000 area. So about a 10% correction. Daily chart, I keep saying this all the time. You know, we get all kinds of reversals, but you always have to assume the market is going to buy every one of them, even a big one like this, 10% correction, they bought it. And these smaller ones, they look terrible when they're happening like that or that, and they're minor. You know, a week or two later, you know, you look back and say, you don't even notice it. So, you know, right now in the daily chart, traders are wondering, is this like all these other big bear days and the market just keeps going up, or is it different? I think there's a 50-50 chance that this is just going to be a bear trap and we're going to go up to another high. And there's a 50-50 chance that we've begun the correction. So on the daily chart, we have a nested wedge. On the daily chart, we definitely have a wedge rally here, a very strong bull breakout, and profit taking. And typically the third time you get profit taking, you get at least a couple legs down. We've already had 2 legs down, 1 pullback, 2, but you know, we've tested the most recent higher low. So we've done the minimum that you would expect from a wedge rally, 2 legs down, testing the most recent higher low. But I think it's more likely we're going to come down here. Whenever you break out, you got to break out here above this. You tested it, you broke out again. You tend to test breakout points. That high, this high. We're currently testing this high. So the bulls are going to try to get a double bottom with this low. But I think if we do go up, we'll form a lower high, and then we'll get reversal down to here or here, 5,200, you know, maybe down to 5,000. So somewhere in the next few months, I think we're going to be down here. What happens if we just do this and break strongly above that? Then I'll change my mind. I always change my mind. You know, every new tick is new information. And when I get new information, I don't stick with my prior opinions. You know, I reassess and I make a new judgment. And that's true during the day as well. You know, a lot of times, you know, one outcome is more likely than another. And then you get new information with every tick. And all of a sudden, another outcome becomes more likely. And, you know, one of the difficult things as a trader is making that change. You know, you were very bullish and now you're very bearish. It's difficult to make that change, but it's important. Right now, we're testing the most recent sell climax high. The bulls want a breakout and then a measure move up to yesterday's high. And the bears hope we get a double top, a break below yesterday's low, which is also the October low, and that would trigger the sell signal on the monthly chart. Right now, we're at the top of a trading range. The trading range lasted over 5 hours. This is the open of the month, so let me attach that to today's open. Can you sell the market here? When we were at this price yesterday, we had a big bull bar, and they sold it. I wouldn't do it. This is a reversal, a sell-off and a reversal up. So to sell, I think the bears will need a pretty good sell signal there. Right now, the market's deciding, are we going to break out above that and go up? I copied base station on my other computer, and I copied this chart over from the other computer. And TradeStation did an update on the other computer a few days ago, and it did not do the update on this computer. So TradeStation was unable to open the chart that I created on my other computer. So this chart does not have all my lines on it. For example, I forgot to put in yesterday's low, yesterday's high. I put them in now. Resistance in the chart, the most important support. Always look at yesterday's high and yesterday's low. Okay, consecutive bull bars closing on their highs, and both bars are big. So there will be more traders buying the market than selling. So it increases the chances we'll go higher. I'm going to put one more line here. This is really the top of the trading range here. Okay, now we have consecutive big bull bars closing on their highs. We're breaking above a bear trend line that I do not have drawn here, but we're also breaking above the top of a trading range. And And this is really an important bar, bar 3. If it's a bear bar closing near its low, if it looks like 45 or 48, then this is probably a bull trap and we're probably going to go down. The minimum the bulls need is no bear bar. So even if it's a small bull bar like this, the odds are we're going to go higher. So bar 3 is really important. It's the follow through after a breakout. I don't know if you can see this, but look at this. We have a low, we have a lower low, a lower low, a lower low. But we've also had a high, a higher high, higher high, higher high, higher high, higher high. We're in an expanding triangle. So from that low, excuse me, from that high, expanding triangle means you keep getting higher highs and higher lows, and you keep reversing. And then at some point, the market goes ahead and does something else. As you can see, we have a low, we have a high, we have a high, we have a low, a higher high, lower low, higher high, lower low, higher high, lower low, higher high. And the bears are hoping that the pattern continues and that we reverse down. And the bears want 3 to be as bearish as possible. What happens if 3 looks like 71, a small bear body? Traders will not sell it. There probably will be more buyers than sellers below. So for this to be the high and the start of a swing down, the bears need as good a bear bar as they can get. A decent sized body, 45, something like that. It's supposed to looks like 14. It's probably not big enough compared to the 2 bull bars. So anything other than a pretty good bear bar, there'll be buyers below and we're going to go higher. So right now the market is in a buy the close market. 3 is very important. What happens if 3 looks like 68, a relatively big bull bar closing near its high? That would be really good for the bulls because then we'll have consecutive above the trading range and the body of the second bar will be completely above the trading range. And when you get that, there's a 70% chance that you'll get at least 2 legs up and a 70% chance you'll get some kind of a measured move up, maybe just based on the bodies, the body of the first bar to the open of the first bar to the close of the final bar of the breakout, maybe a measured move based upon the trading range. And the glaring thing is this pair of big bear bars. The bears wanted a measured move down, but anytime you have a big move like that and you're thinking about a measured move, you got to think that the measured move can be in either direction. So don't just assume that the measured move has to be down. It could be up. And look what happens if it's up. This is not a coincidence, right? That this low from yesterday is exactly where it had to be so that a measured move up from here goes to yesterday's high. The computers are always, it's a game of chess and they think, they think far ahead. So those computers knew that this sell-off could have an upside breakout and a measured move up, and yesterday's high is a really important price. So let's make this low exactly a measured move down from this high and yesterday's high. So from yesterday's high to this high, that's where yesterday's low was. Okay, so bar 3 is an example of what I said. The bears hope that it's a bear bar and therefore this is a failed breakout. But I said to sell, the bears needed a pretty good bear bar closing near its low. They didn't get it, right? So that is not as bearish as the bears want. So there probably are more buyers than sellers at and below 3. However, it's not as bullish as the bulls want. The bulls wanted consecutive big bull bars closing near their highs and above the trading range. And they didn't get that. They have consecutive big bull bars closing near their highs, but only one of them is closing above the top of the trading range. So not as bullish as the bulls want and not as bearish as the bears want. And that's trading range type of behavior, except that we had a very strong sell-off, and now we've totally reversed the sell-off. We're above it. So it's more bullish than bearish right now. The market, can you buy at the 3 low? You probably can. I think it's probably not worth doing. An expanding triangle is basically a trading range that keeps getting new highs and new lows. Can you short? I would not short. So it'd either be long or flat. A lot of times the market will do this and then go up to a new high, and then do it again, and go up to a new high. So a small pullback bull trend where it keeps pulling back. The pullbacks are small, but the market keeps making new highs. We broke above the Globex high. 90% of days either break below the Globex low, like yesterday, or above the Globex high, like today. And this is what I mean by a small pullback bull trend. This is a 15-minute Globex chart where the market just keeps pulling back, but it keeps making new highs. So it's a bull channel that looks weak, but it can last a long time. It can go up a long way. Here's an example of a small pullback bear trend where the market keeps pulling back, but the channel stays tight. The pullbacks are small, and the market keeps going lower. Eventually, the bulls give up, and you get a big bear breakout. Yesterday, we had consecutive inside bars. We had a big gap down. So a gap down is a bear trend. It's an invisible bear trend. You don't see any bars. But the market overnight went from that close to this open. So there's a bear trend, and then an II and a bear trend. 50-50 chance it will be the final bear flag, that a breakout below will fail. And 50-50 chance it'll be a bear flag in a bear trend that lasts a long time. And that's what it was. We collapsed over here on bar 4 and pullbacks and a small pullback bear trend. This is a breakout. See how this bar is bigger than these bars? So that's a change in behavior. So we had 3 lows here, 1, 2, 3, and the bulls hoped for a wedge reversal. Instead, we got a breakout, and we got another 3 lows, 1, 2, 1, 2, and 3. Okay, so we had consecutive parabolic wedges. We tried to rally, but the pullback is still small, and the bear channel is still tight. The rally was probably going to be minor, and it was. It only went up a little bit, and then we came down here. This was a potential lower low major trend reversal or low double bottom, but when a bear channel is really tight like this, the pullbacks are all brief, 1 or 2 bars, the reversal is probably going to be minor, which it was. Outside up bar, we went below the prior bar's low, and now we're above the prior bar's high. Good for the bulls, especially good if the bar can close on its high. The bigger the bar is, the more it closes on its high. The further above the high of the prior bar it goes, the more likely we're going to continue to trend up. So good bar for the bulls. We closed above 3. We closed near the high of the bar. Increases the chances of higher prices. Each one of these highs is a target. Yesterday, we had a couple of interesting things early on. I always watch for this. You have a sell-off, a breakout, and a pullback. And then I look to the left, the high of the pullback and the low of the breakout point. There's a gap, there's a space between this high and that low. Then we got another breakout. We broke below that low. And then we got a reversal low. And the high of the pullback, the high of this pullback went above the breakout point. So there's no gap. But the body of the pullback, look at the highest close here. It did not go above the lowest close here. So there's a gap between the bodies. So we have a gap and a body gap. And when you get that, there's a 70 or 80% chance that the market is going to be mostly down for the remainder of the day. It's a small pullback bear trend. And then when you start getting pullbacks that go above breakout points, we broke below that low and we pulled back above it. All right, you start here, no, but here, yes. Once you start to get pullbacks going above breakout points, traders start buying at prior lows. So we knew there would be more buyers than sellers at that low. We went up. We knew there would be more buyers than sellers at that low. We went up. We knew there'd be more buyers at this low. Traders bought with a limit order here and went up. This late in the day, it's always dangerous to trade the last few bars of the day, especially when it's the last day of the month, because you can get really big bars and the market can move fast, but it still worked. So if a trader bought this low and bought more 5 points lower, 10 points lower, he could have gotten out break even on bar 79 with his first buy and with a profit on the lower buys. I sometimes trade other markets. By the way, this is still a buy the closed market, so buy for any reason and exit below a bear bar closing below its midpoint, or exit the size of a scalp below any bar, even below a bull bar, like here. You know, if you were long here, you could exit the size of a scalp below 71, or you could exit below a bear bar closing below its midpoint. You know, if you're buying at the top of a rally, you believe the trend is strong. If the market does something that tells you the trend is no longer strong, you have to trade it differently. And it's better to get out and look to buy pullbacks instead of continuing to buy near the top. So right now, this is a buy the close rally. This is a strong enough breakout to get 3 legs up. So that's 1 pullback. This is 2. And you'll get a pullback probably within the next few bars, and then 3. And traders will wonder if it's a parabolic wedge top. But right now, it's only a buy. By the way, I trade other markets as well. And yesterday was interesting. Here's gold market. Okay. This is a daily chart of gold. And 2 days ago, when it was up at 2,800, I shorted gold. And the reason for that, and I bought it back yesterday with a profit, obviously. But take a look. But here's 2,700. What happened? It went above 2,700, reversed. Here's 2,600. It went above, reversed. Here's 2,500. It went above, reversed. Right. Here's 2,400. It went above and reversed about 50 bucks. Right. Here's 2,300, 2,200. Went above, reversed at least 50 bucks. Right. So, you know, when you see something obvious that's happening at every big round number, you know, maybe it'll do it again. Maybe it'll go above 2,800 and reverse down 50 bucks. So, you know, there are patterns that on the daily chart that sometimes set up for really quick, easy trades. All right, so the bears want a low 2 top. Remember, 70% chance we were going to get a second leg up after seeing 1, 2. We had a pullback 3, 4, and now we have a second leg up. The bears want this to be the high of the day, you know, and it's a low 2 top. It's a second reversal down from above this trading range. But we have 5 bull bars. 3 is a bull bar. Black and white chart, it doesn't look like a bull bar, but it actually is a bull bar. So again, like I said, there would be more buyers than sellers at the 3 low. There probably will be more buyers than sellers at the 5 low. You got to be wondering, is this going to be a parabolic wedge rally? Is it going up too far, too fast? And with 3 legs up, will we pull that? This is a similar thing. You got a big rally, a pullback. A brief leg up, a pullback, and a third leg up, and then more of a pullback. So that was a parabolic wedge buy climax. Parabolic wedge buy and sell climaxes are very common. Here, up and then a smaller bar, a pause, up again, smaller bar, pause, and up a third time. And but this is a breakout. A lot of times, you know, if the third leg up is very big, you start the count over again. So you could look at this as a new first leg and then second leg. We got an I and a buy climax. At this point, it was likely we would get a third leg, but once you get an I and a buy climax, bulls will exit and bears will short. That's a credible sell setup. Another way to look at this is a parabolic wedge. 1, pause, 2, pause, 3. And then a failed breakout above the parabolic wedge. In any case, you get a really strong rally, and then that's a sell. Here, consecutive inside bars. It's not an inside bar. Its high is at or below the high of the prior bar. Its low is at or above the low of the prior bar. So this bar is inside of that bar. And then we have a second inside bar. So you have consecutive inside bars. That's a triangle on a smaller time frame. Breakout mode. 50% chance you're going to get a successful bear breakout, 50% chance you'll get a successful bull breakout, and 50% chance the first breakout up or down will not get very far and the market will go the other way. Hesitation, 3, 4, 5, 6. So traders are wondering, are we going to come back to the middle of the trading range? Maybe a 50% retracement. I said the high of yesterday and low of yesterday are important. And the close of yesterday is important. And the open of today is important. And the low of yesterday is important. The open of today is important. So let's take a look at that. So yesterday's low and today's open. Anytime you have two important prices, you always got to be thinking they might generate a third important price. And there's a measured move from those two prices. Potential target. And yesterday we had a breakout pullback channel. Right? So the start of the channel is also a target, which is that high, which is right around there. So we have a couple magnets a little bit above. Yesterday's range was really big. We're in the middle third or so of yesterday's range. And whenever you have a really big day, like here, there's an increased chance that the next day will be an inside day, that it will not go above the high of the big day. It will not go below the low of the big day. What the bulls are hoping is a big day, maybe an inside day. Here it doesn't, it still was an inside day, but we closed near the high. So the bulls want a big bull trend day. A big day and then an inside day. Big bear day and then an inside bull day. Big bear day, bulls hoping it's a bull day. They'd like to break above yesterday's high. But you got to be thinking this could be an inside day today. That we don't go above yesterday's high and we don't go below yesterday's low. And that means if the market goes up, traders look for reversals down. If the market goes down, traders look for reversals up. Can you short below 6? 6 consecutive bull bars. You don't short when there are 6 consecutive bull bars. You need to see some bear bars. What about selling below 7? I think most traders are not going to sell below 7. We do have a wedge here. We're up on 2 and then pause 3, up on 4, pause 5, and then up on 7 and reversal. So we have a small wedge. You don't see it that well on this time frame. But if I put up a smaller time frame chart, you can see the wedge. Here's a 1-minute chart. So 1, 2, and 3. A very small pullback bull trend. So the first reversal down will probably be minor. The best the bears can probably get is maybe a test of that low. Remember, if you're long, you do not have to get out, even though it's a parabolic wedge or wedge top. But if 7 closes below its midpoint, I would get out below 7. If 7 goes the size of a scalp below 6, I would get out. So yesterday, for example, if you made the mistake of buying a close of 76 because you have 3 big bull bars and the bodies are getting bigger, and you're ignoring the fact that you're at the top of a trading range. Let's say you bought that 76 close, and then the market fell below 76, and it fell the size of a scalp below. Do you keep holding long all the way down here, risking 35 points, or do you say, I'm just going to get out the size of a scalp below the prior bar, even if it's a big bull bar, and you get out down here, you'll lose 20 points, but it's better than losing 35 points. Size of a scalp recently, most days it's 5 points, sometimes 10. So that's 20 ticks. And for a bear to make money shorting below 6, for him to make a scalp, 20 ticks, 5 points, it has to fall 22 ticks below 6. So when I say get out the size of the scalp below, I mean 22 ticks below. You could do 20, it doesn't matter. But my thought is, if it goes 22 ticks below 6, then a bear who sells 1 tick below 6 can make a 5-point scalp. To make a 5-point scalp with a stop order, if you sell 1 tick below 6, you place a limit order to take profits 5 points below, 20 ticks below. So that's 21 ticks below 6. But your order is not going to get filled unless it goes 1 more tick. It has to go below your order. So it has to go 22 ticks below 6. Traders are wondering, the bulls are wondering, is this the high of the day? Is this another reversal in the expanding triangle? And as I said, if instead of waiting for 7 to close on its low and taking a chance that it might be a huge bar and then exiting below the huge bear bar, I recommend getting out the size of a scalp below the low of the prior bar, so 22 ticks below 6. If it goes 22 ticks below 6, then a bear shorting below 6 could make money, could make a scalp. And you really want to be long at the top of a bull trend if bears are making money with stop orders. And for me, no. If I'm buying the close, buying at the top of anything, I want the bull trend to be very strong. Bears cannot make money with stop orders and strong bull trends. If a bear does make money with a stop order, then the bull trend is no longer a strong bull trend, and I'm no longer going to continue to trade it like a bull trend. I'm no longer going to buy the close of bull bars. I'll wait for a pullback and then buy a pullback. Big outside down bar. Can you get up below 7? Excuse me. I don't think you have to, but it's okay. You can also get out 22 ticks below 6. And then if we get a bull bar closing in its high on 8 or 9, you can buy it again. The bulls know that, so they're buying the close of 7. They know a lot of bulls will get out 1 tick below 7, and they don't want bulls getting out. So they'll buy the close of the bear bar, trying to prevent the market from going below 7 and scaring bulls out. I talked about yesterday being a small pullback bear trend with a gap and a body gap. So a gap between this pullback and that breakout point, and then a body gap, this pullback and that breakout point. And when you see that, you don't buy. You don't buy until there's a clear bottom. Small pullback bear trends constantly form wedge bottoms. We have the wedge here. We can call this maybe an attempt at a wedge. This is a wedge. If you get a second reversal, maybe you buy, but only if it's perfect. And this is 4-bar trading range with the big tail on top. That's not perfect. I'm not going to buy that. Here we have a low double bottom, a failed breakout and reversal, bull bar closing near its high. I will buy above that, but for a scalp, it's probably going to be a minor reversal. But whenever you see 2 gaps or 2 body gaps or a gap and a body gap in a bear trend, don't buy, only sell. And the opposite is true if you see a rally where there are gaps and body gaps, 2 or more. Don't sell, only buy. Okay, bulls trying to get a breakout. A bull breakout is a bull bar closing near its high and closing above the high of the prior bar. Bar 1 was a bull breakout, a bull bar closing near its high and closing above the high of the prior bar. Bar 2 was a breakout. Bar 3 closed above 2, but I would not call it a breakout because it's not a big bull bar closing near its high. Bar 4 is a breakout, a big bull bar closing near its high and above the high of the prior bar. And so far, bar 8 is a breakout, a big bull bar closing near its high. Now I drew this line in here. Do we have to stop there? No, the market could totally reverse the day and go up toward yesterday's high. And 8, you look at it that and you say, oh, I wasn't expecting that. So it's a surprise. And whenever the market does something surprising, it typically will have a couple legs up. So if 8 closes near its high, we'll probably have at least a couple legs up. Remember I said that this was a measure move target. Open of the day is important. Yesterday's low is important. So the computers know that 2 important prices generate a third important price, and they'll often be profit takers. It's a resistance level, so they'll often be profit takers at the measure move. And you can see there's a little bit of profit taking here. Now, 8, it can be a bull trap. It can be like 9 yesterday, big bull bar, and then it traps bulls into hoping it's the start of a bull trend. Instead, the market goes down. So the close of 8 is important, and the next bar is important. Is it going to be a bear bar? Yesterday, 75 was a bull trap. A big bull bar closing near its high, closing above the high of the prior bar, closing above the high of the prior 30 bars. All right, so it looked bullish, but it wasn't. It was bearish. More traders sold the close and sold the high than bought. More sellers than buyers. The bulls want this bar to be as bullish as possible. They want a bull bar, a big bull bar closing near its high. So far, it's a bull bar and it's a big bull bar. And let's see where the close is. That's a good close for the bulls. Is it good enough to buy the close? I would not. I would wait for the follow through bar. Remember, I said most bulls would not exit on 7. So bulls are still long. They're hoping that we get a gap between the 9 low and the 7 high, and maybe a measure move up. So the next measure would be trying to get a trading range here. And instead, we're breaking above the top. The most important price right now on this red line. Yesterday's high, plus it's that measured move from yesterday's low to the top of that sell index. And it's also at the 60-minute moving average. So we got a cluster of magnets and low of last week. So we have a cluster of magnets up here. And the bulls would like to get above all of them. I do not think the bulls will get above all of them. They might test them, but I don't think we're going to break significantly above them today. Important bar again, kind of like bar 3. Whenever you have a breakout, the next bar is important. Will it be a big bear bar closing near its low? In which case the breakout then was a failed breakout and a trap. I'm sure you saw that the unemployment report today was bad. Did not create many jobs in last month. Looking at the report, they forecast that we were going to get 180,000 jobs and we got 12,000 jobs. So why is the market going up if we have a sign that the economy is weak? It's going up because a weak report increases the chances of lower interest rates. Lower interest rates means money is more available. And if you have more money, you got to invest it. And one way to invest it is to buy stock. So it should make the price of stock go up. Okay, the market's ignoring that measured move, so I'm going to ignore it. Again, the most important price is a little bit above yesterday's high. This measured move, last week's low, 60-minute moving average. A lot of magnets up there, so that's where we're headed. Now I have a measured move based upon this trading range. If it goes above it, then I would look at a measured move from today's low to the breakout point, which is the high of 7. No surprise, it's around that cluster of magnets. Traders are buying at the market. You can buy at the market, right? Your stop right now is below 7. So you're risking 20 points, so you trade small. That means trade maybe 20% of your normal size. So if you trade one E-mini, 20% is 2 micro E-minis. There are 10 micro E-minis per E-mini. And if it keeps going up, you can add. And if you get a bear bar closing near its low in its lower half, you can get out below the bar. If the market falls the size of a scalp below the low of a prior bar, you can get up. So we have a higher low, double bottom, little trading range, higher high double top, higher low double bottom. And we're pausing. Some bulls are taking profits at the measured move. Well, we have a cluster of magnets a little bit higher. So we're probably going to go higher. Can you sell and scale in higher? Nope, nothing to sell. Bears are not making money. So you do not sell until you see that bears are making money. And bears are not making money, so you do not sell yet. When it's impossible for bears to make money, traders buy. And they use the appropriate stop, and the trade's small enough so that if they get stopped out, they don't lose any more on the trade than on any other trade. Let's say you're flat here. Let's say you don't hold a position, and you're thinking, "Oh my gosh, I wish I was long. I hope we get a pullback so I can buy it." You just buy at the market, put a stop below 7, and then if you get a bear bar closing near its low, get out below the bar. And if you get a bull bar closing near its high right afterwards, you buy it again above the bar. Can this be the high of the day? Can 8-9 be a bull trap and the high of the day? Maybe 20% chance that that'll happen. But you always have to wonder, about, how do I get out? And as I said, if you get a bear bar closing below its midpoint, get out below the bear bar. If the market goes the size of a scalp below the low of the prior bar, then a bear could make money selling below that prior bar. And you don't want to be trading this like a buy the close bull trend if the bears can make money. Because if the bears are making money, it's no longer a buy the close bull trend. It's a buy pullback bull trend. So you get out. There are other things that traders look at on charts. This is a daily chart, and I can see on 4 dashed lines. That's a 50-day simple moving average, 100-day, 150-day, 200-day. Here we got near the 200-day, and they bought. Here we got near the 50-day, and today they're buying. Here we pulled back to the 50-day, and they bought, but they didn't keep buying. We got a lower high and a second leg down. And right now, I suspect that if we go up, we'll get a second leg down. So I think this will end up as a head and shoulders top, left shoulder, head, and then right shoulder. Big gap down. You always hear that gaps always close, and that is wrong. Gaps down always close, but gaps up do not always close. Here's a gap up. It's possible that never closes, ever, ever, ever. Pandemic, here's a gap up. It's never going to close. Down here at 2,900, that gap is never going to close. This gap is never going to close. These gaps are probably never going to close. The market's in a bull trend on the yearly chart. So it goes to new highs and pulls back to higher lows. And this low is so far below where we are, the market's never going to fill that gap. But if you have a gap down, 100% chance every gap down is going to close, because the market's in a bull trend. It's always going to make a new high. And if it's going to make a new high, it's going to close those gaps. So 100% chance this gap is going to close. The question is when. Is it going to close over the next few days, or are we going to come down here and then 6 months from now go up and close that gap? I don't know. We'll find out. Right now, it's more likely that we're going to keep going higher. So far today's a good day. It's undoing a lot of yesterday. I think we're probably going to get a lower high and an attempt at a higher low major trend reversal. When you get any kind of a major trend reversal setup, head and shoulders top, a big wedge, any of those things, only 40% chance you're going to get an actual major reversal into an opposite trend. So here we got a wedge on the daily chart, 1, 2, 3, 40% chance this is going to lead to a bear trend down to here, down to here. 60% chance it will not. 60% chance it'll be brief and we keep going up, or we'll go sideways for a while. Still buy the close, buy the market, buy for any reason. I'm going to get rid of this measure move based upon this double top and double bottom neckline measure move up. The market's ignoring it. I'm going to ignore it. I have a whole bunch of magnets here, so even if we pull back for a bar or two, we're still probably going to go higher. This dashed line is the 60-minute 20-bar exponential moving average. Here's the 60-minute chart, and it's a blue line here, and I have it as a dashed line here. The reason why it keeps reversing on this chart is I wrote the average to calculate at the close of every 5-minute bar. So here, it gets calculated at the close of every 60-minute bar, so once an hour. Here, it's getting adjusted 12 times an hour. Is anybody selling here? Obviously, yes. Because if you're buying from someone, and that means someone is selling. Now, why would anybody be so stupid as to sell if the market's going up? Well, there are a bunch of reasons. Some of the sellers are bulls who bought down here, and now they have 20 points, and they're taking their profits. So you got bulls selling. And then you also have traders trading on tiny time frames. Computers, people. I'll put up a 1-minute chart. Right? Oh, we got a wedge top. I'm going to sell. Right? So 1 minute, traders, 2-minute traders. They bought and they're taking profits. A scalp is 5 points on the 5-minute chart. On a 2-minute chart, the scalp is going to be smaller. In general, a scalp is about the size of a bar. So if you're on a 5-minute chart, the average bar is about 5 points tall. The scalp is probably going to be about 5 points. If you're on a 1-minute chart, average bar might be 2 points tall, and then the scalp is 2 points. If you're on a 60-minute chart, the average bar might be 10 or 20 points tall. If you're looking to scalp, exit within a bar or two, you're looking to make 20 points. If you're on a daily chart and you're looking for a quick trade, your stop might be below a prior bar if you're long, right? And so you want to make about that much. So, fast money trader on the daily chart is looking to make about the size of an average bar. The bodies are shrinking, 8, 9, 10, and 11, but it's still a lot of bull bars. This is 12. It determines the appearance of the first 60-minute bar. And so far, it's a big bull bar closing near its high, closing far above the high of the prior bar, and reversing most of yesterday's big sell-off. So it's a very good bar. We're probably going to get to the 60-minute moving average either today or early next week. It's possible we just go up and then do this, big bull bar, and then this, and then get some resumption up next week. So we're going to go higher. We're probably going to get to the 60-minute moving average either today or on Monday or Tuesday. If we can get there by going up by going sideways for a lot of bars. Less aggressive, bars are getting smaller, but still more buying than selling. We've only had one bear, 12 bars into the day, and only one bear bar. So do you want to short? No, every bar is owned by the bulls, so it's foolish to short. Does the market have to stop at this resistance? No, but it probably will. Why? Because very often, if there's important resistance, here we have a whole bunch of stuff all together. Last week's low, you got this measure move, the pink line. You got the measure move, the green line. You have the 60-minute moving average. You have yesterday's high. You have a whole bunch of resistance here. And now we have a bigger bar 12. The market reached up to grab that resistance. So we're probably not going much higher. This will attract profit takers, bulls selling out of longs. So bulls are going to be pretty quick to get out. So what happens? Can today become a bear trend? No. Well, I shouldn't say no. 20% chance today will become a bear trend. So 80% chance it's either going to continue up, not likely, or enter a trading range, likely. So whenever the market races up on the open, a lot of points. So we're already the size of an average day. Here's the daily chart. You look at the size of today and then look at these other days. Today's already about as big as those other days. So today's probably not going to get much bigger, and therefore probably not going to go much higher. But it's very strongly bullish. The first 12 bars, we only have one bear bar. So we're probably not going to go down very far. Can we get down to the bottom of this buy climax? Maybe 30% chance we'll come down here at some point today. And maybe there's a 20 or 30% chance that we'll get 30 points above where we are. But most likely, we're going to start to enter a trading range. I'm going to turn the screen on for a moment. I have a collection of slides. Every day I create charts. I've been doing this for 40 years now, almost 40 years. Okay, so this is what today's probably going to do. A gap up and a bull trend from the open, and then a trading range. So a very strong bull trend. Here it lasted all day. 20% of the time you get a really strong bull trend that just keeps going up and up and up. 20% of the time you get a really strong bull trend and it reverses. 60% of the time, if you get a really strong bull trend, it just reaches its target and then goes sideways around that target. So 60% chance the day is soon going to start to do this. Normally, the rally ends before the end of the second hour. So there's probably very little left to the rally if we go up at all. Really strong rally, and then this big bear bar, but only a couple bear bars all day, probably a minor reversal. So this is probably, for at least the next couple hours, we're probably going to do this. And probably we're going to be doing it all day. The bears are hoping that we get a very big buy climax, and they're not expecting a bear trend right away, but they're hoping that we go sideways for a couple hours and form a double top or a lower high, and then later in the day get a reversal. At the moment, 20% chance we're going to get a big reversal later in the day. That means 80% chance for a not. You can see a big bull bar 12. The bars were shrinking, and then pop, big bull bar up into that zone of resistance. A lot of bulls are taking profits because they know we're probably not going to go a lot higher, and they have big profits. So and their stop is down here. So it doesn't make sense if there's only a little bit more profit potential and the risk is much bigger than the reward. Maybe take some partial profits or full profits. If you have not exited yet, I would get out below a bear bar closing below its midpoint, like 13, or you can get out the size of a scalp, 5 points, 22 ticks below the low of any bar. But the day is pretty much over right now. Probably. This is probably in the next couple of hours, possibly for the rest of the day, we're going to do this. Can you short below 13? Arguing, well, it's probably a trading range, and therefore I can sell. If it goes up, I can sell more higher. If you're a computer, or if you have a big account, you can do that. But most traders should not sell below 13 except to exit longs. Really important thing right here, bar 12, a big bull bar closing the high. It's the final bar of the hour, right? And it's a very big bull bar. And traders always want to see what's above a very big bull bar. So a lot of times you'll just go a tick or so above the prior bar and get profit takers. And you can see 13 went just a tick or so above 12, and traders took profits. So instead of buying the breakout above the big bull bar, they sold. So a lot of times you get a big bull bar, and here we sold off for 3 hours, but not all that much. The day just went sideways. A big bull bar, and then we did that. Can you buy the close of 13? Well, like I said, you could sell below 13 and sell more higher. And you can buy the 13 low and buy more 5, 10 points lower, right? Well, at this point, it's probably better to let the market go down for a couple small legs and then look to buy again. And for the bears, it's better to wait for a second reversal down. So wait for some kind of a double top and then sell. We are probably in a trading range right now. And we might be in the middle of it. If this is the middle of it, then the bottom of it is somewhere down here. Big buy climax, a big magnet down here. Big sell climax yesterday, big magnet right there. Theoretically, bears who are short put their stop above the top of the most recent leg down, especially if it's the sell climax. Bulls who are long, a lot of them put their stop 1 tick below the bottom of the buy climax, or 1 tick below the bottom of that change the buy climax. So there are a lot of bull computers that will sell down here, and the bears are trying to get it down there. Is this sell the close, sell the market? We're in a trading range, and we're probably not going to go down all that far. Trading ranges tend to be confusing, and a lot of times it's better to wait for second buys and second sells. So trading range here, first reversal, 5 bull bars, better not take it, wait for a second sell below that bar or below that bar. And then here we're trying to reverse up. You have 4 bear bars. I don't want to buy the first reversal up, even though it's the bottom of the range. I'll wait for maybe a second or a third or a fourth reversal up and then buy. Or if I do buy, I'll use a wide stop and buy more the size of the scalp lower, or buy more if there's a second or third buy. Now, I said it's reasonable for bulls to get out the size of a scalp below 13. Well, guess what? It's also reasonable for bulls to buy the size of a scalp below 13. They'll bet that this reversal down is minor, because 80% chance it is minor. 80% chance this is a pullback in what will become a trading range. So 80% chance we've begun a trading range, or this is a brief pullback and we get another leg up. So maybe 1 pullback, 2 pullback, 3. As I said, only 20% chance we're going a lot higher. Only 20% chance we're going to reverse down to the low. And 60% chance we're going to be doing this for at least a couple hours. And then the bulls will hope for a big rally, trading range for here, 2 or 3 hours. The bulls want the bull trend to resume. The bears want the bear trend. The bears want a reversal. So this is the next couple of hours. Here, this is like 3 hours. This is like 3 hours. But this is what traders will look for either trend resumption up or trend reversal down. But most likely, we're going to be sideways for the rest of the day. Most likely, we're not going to do that. Most likely, we're not going to do that. Most likely, we're just going to stay sideways all day. Huge rally, sideways. This is not nearly as big a rally, but here, big legs up and down, sideways. Here, big rally, a lot of bear bars, and basically sideways for a couple hours, sideways to a couple hours, a little bit of trend resumption up. Here, sideways to down. Big rally, trading range, trying to get resumption up, they failed. Big rally, and then that. I have lots of examples of it. And why do I have so many examples? Because it's really common to get a big trend and then a trading range. Big trend, trading range. You have lots and lots of examples here. Big trend, trading range, resumption up. See all the examples? I have lots and lots of examples. No matter how strong the trend is, sideways for at least a couple hours. Now, when does this become sell the close? When does it become so bearish that you cannot deny that it's going down? No, not yet. We're not even at a 50% pullback yet. Remember, I told you buy climax, the bottom of the buy climax is a target. Okay, there's a 50% retracement. So there'll be some buyers here. I'm going to get rid of this measured move for the time being. Now we're wondering about how far down the reversal will go. Where is the bottom of the trading range? Is it around where we are now, or is it all the way down here? When do bears start to sell? At a minimum, they want to see at least 2 bars, 13, 14. So you might get some bears selling here, 15. But I think it's better not to sell, because the trading range is more likely than a big bear trend. So what happened to all the bullishness? You know, the bulls bought because they were confident that there were so many magnets up here, so much resistance, we had to come up to that area and test it. And we did. And so the bulls sold. They got what they wanted. They got up to that area, and they don't want to buy any more except lower. Trading range behavior, big up, big down, creates big confusion. You know, wait a minute, first 12 bars, we only had 1 bear bar. That's really bullish. Yeah, but it's also a buy vacuum test of resistance. So that does not mean bulls will buy forever. Once you've corrected about 70% of a rally, you're usually going to get down, all the way down. So we're probably going to go down to around the 8 low. Nothing to do here. If you're flat, I would not sell. Just like up here, I said 12 traders might take profits. Here, the bears are going to be taking profits. We're at the moving average. We're back at the breakout point, and we're near the bottom of the buy climax. So a lot of bulls will look to buy around the 8 low, the 7 low, so somewhere a little bit lower. Some are buying at the moving average. And for the bears, I think we're in a trading range, and you don't want to be selling too low. And this is, I think, too low. I'm going to turn the screen off. This is my encyclopedia. I have a collection. I'm turning it into a book. And I'm probably about 70% done with the book. Okay. Big up, big down, big confusion, likely trading range. Big up, big down. Everybody's wondering what the heck is going on, you know, and that's what follows. Big up, big down. Here we reverse back up again. We never went all that far up, and here we were sideways for several hours. Big up, big down. We rallied, but basically a trading range day. Those are hoping that we're going to do this. but they need a bull bar or 2 bull bars. If they get it, bulls will start to buy again. Now, I said there was a 20% chance this could become a bear trend. I'm going to open another PowerPoint. Buy climax. Sometimes the rally, this big rally, and the market just reverses down all day. But if the rally is as big as today's was, the chance of that, big rally and bear trend, the chance of it is 20%. Okay, so traders are buying here using a wide stop, and they'll buy more lower. But because we're probably in a trading range, a lot of the traders buying are looking for scalps, 5 or 10 points. And just like the bulls were selling here, not buying, the bears are buying here, not selling. The bears who sold below 13 or 14 or the close of 15, they're buying back shorts for 5 points. Nobody is pressing bets. Nobody is selling. Big down, big confusion, probably a trading range. And trading range, you don't want to sell too far down from the high. So bulls will start to look to buy around where we are. And they'll buy more or lower. Probably sideways for a few bars here as traders decide, are we going to get below the 8 low, or we're going to hold above it and work back up to the high. So is the bottom of the trading range here, or is it a little bit lower down here? Is there anything 16 can do that makes you want to buy? Well, if it's a huge bull bar closing near its high, it's a buy. But the bears have done enough damage to make a bull trend over the next couple of hours unlikely. So anybody buying is scalping. And a lot of the buyers will use wide stops and scale in. So here we got this big sell-off and traders are buying. Bears are buying back shorts. Okay. Some bulls see this rally and they put their stop 1 tick below the buy climax, 8, or 1 tick below the bull leg, 7. And they're defending their stops. We're getting near their stops, so they're buying again to prevent the market from getting there. They know that a lot of bears will be hesitant to sell too low, so they know that you'll be getting fewer bears, and the bulls have a better chance of getting a bounce. Here we got bull reversal bar 16, and we're going down. Why? Because it's not a strong buy, and the bears are betting that they can get down to this area. So bear scalpers are selling the close of 16. Confusion, a hallmark of a trading range. Whenever you look at something and say, oh, it's pretty bullish, and this is pretty bullish. Wait a minute, that's bearish. Whenever there's confusion, the market is probably going to go sideways. And the reason for that is if traders are confused, they don't want to be buying too high and they don't want to be selling too low. So they tend to buy low and sell high. And they're confused. They don't think the market's going to go very far before reversing, and therefore they take quick profits. So confusion leads to traders buying low, selling high, and taking quick profits. And when traders do that, the market enters the trading range. Back at the moving average again, they bought 15 at the moving average, they bought 16, and now 17. Remember, we're probably not going to go down much from here. The bulls are deciding, or traders are deciding, whether we're going to get below 7 and 8 and then go up, or are we going to go up here? Those are the two decisions. Less likely we break strongly below 7 and then go down to the low of the day. Maybe 20% chance we just collapse. 80% chance either we go up from where we are, or we go down a little bit more, maybe to this breakout point, and then go up. Getting a short below 17, betting that we're going to come down a lot further. Remember, I've said only 20% chance we're just going to keep going straight down. And we're also right around 20 points below 13. And a lot of traders look for a scalp of 5 points and a swing trade of 20 points. And so a lot of the bears who sold below 13 are trying to scalp out with 20 points, which is right around the low of 16. Bulls trying to get a micro double bottom, down on 16, up on 16, down on 17, and up on 18. So we're down a lot. So this is an area where it's better to be looking to buy, not sell. Probably more buyers than sellers. 17 low, 16 low, 7 low. So this is a buy zone down here, just like that was a sell zone. Scalping mode, buy low, sell high, scalp. This is kind of tricky if you have a small account. You know, it's easier to trade this stuff if you can scale in and use wide stops, which I think you can't do if you have a small account. So even though it's a buy above 16 for a scalp up, I think it's really not a great buy for most traders. Better wait. We have an inside bar of 17, and so far, second one, 18. And the easiest trade would be for if it to go above 18 and then below and then reverse up a second time. That would be a higher probability bet. And for the bears, I think you should not be selling down here. Is this buy the close again? Traders who buy are scalping. So there'll be sellers 5 points above 16. Think that I'm going to do that. And we might, but as I said, even if we do, it's still going to result in mostly a trading range. The bulls who bought above 16 are taking profits. I did buy, I did take profits and back to flat. And what do I do if it keeps going up? I think we're in a trading range. So I only want to buy low. I don't want to be buying high. I want to buy pullbacks. The bears, can they sell here? Are we high enough to sell? I would not. 18 is a surprisingly strong bull bar. So we'll probably have at least a small second leg sideways to up. So if we're going to get a small second leg sideways to up, I'd rather wait to see what the second leg looks like and then think about selling. I want to say something about what took place here. I bought on a stop, one tick above 16, and I had one tick slippage. So I'm not going to scalp 5 points from my entry. I'm going to scalp 5 points from my order. So I did not try to scalp out with 5 points from my actual entry price. I scalped out at 5 points from one tick above 16. And it went up 22 ticks and pulled back. So I was able to get out. So I made one tick less. I made 19 ticks instead of 20 ticks. Now, I said this was a buy the close rally. Reasonable to buy the close. And therefore, it was reasonable for bulls to buy 12, although I said there probably would be more profit takers there. So what happens? So let's say somebody did the reasonable thing and they bought the close there. 80% chance that bull is not going to lose money if he can use wide stops and scale in lower. So what he does is he buys the close, uses a wide stop, maybe down, somewhere down here, waits for a bull bar closing near its high, and buys above the high of that bar. 80% chance the market's going to get to the midpoint of his two buys. So he bought that close, and then he bought one tick above that, 80% chance it's going to get one tick above that pink line. I don't have this drawn in precisely. It's pretty close. So 80% chance we're going to go a tick above that line. And 60% chance we're going to get all the way up to that close. 16 is not a strong buy signal bar. So a lot of bulls who bought the 12th close theoretically did not buy above 16. And 18 is too far up to buy. So they'll wait to see if we get a better bull bar somewhere down here. If a bear sold the close of 16, disappointed, sold the close of 15, disappointed 16, they had an opportunity to get out break even on 17 and 18. The bulls who bought 12, disappointed 13, they never had an opportunity to get out without a loss. So some of those bulls will use a wide stop and wait for a bull bar closing near its high, reversing up from the bottom of a sell-off, and buy more. Probably more buyers than sellers. 19 low, so I would not take that short. And I still think we're going to go above that pink line. Is it buy the close or sell the close? I think we did not go up high enough, so I think it's buy the close. The one problem the bulls have is the body on 16 was not as big as they wanted. So some of the scale-in bulls who bought the 12 close did not buy above 16. I just turned the screen off, open another PowerPoint. Again, this is from my encyclopedia slides. Doesn't this look familiar? Looks like today. Rally that accelerated up, and the bulls have bought the close, disappointed by that bar, unable to get out break even. They wait for a bull bar closing near its high, and then they buy more. We fell below the bottom of the buy climax, and still bulls bought above the bull bar closing near its high. 60% chance to get all the way back up there. They can get out break even on their first buy with a profit on their lower buy, and 80% chance that we get to the midpoint. I want this line to be one tick above that bull bar. And then let me shrink that by half. Buy the close rally. They buy the close, buy the close, buy the close. And the final buy the close bar, if you're disappointed by the next bar and it doesn't go sideways to allow you to get out break even, if you wait for a bull bar closing near its high, 80% of the time you'll get to the midpoint and you can get out break even. 80% you can get to the midpoint. You can see there were sellers there, and 60% you get to the original buy. And you can see today, 80% chance we were going to get to the midpoint of the two buys, buy the close, buy more here, and we did. And 60% chance we get all the way back up there. So the bull who bought that close bought more above that bar. 60% chance it's going to get back up here, and he can get out break even on his first buy and with a profit on his lower buy. This sell-off created a problem for the bulls. It made it unlikely that we're going to go a lot higher today. So we still may get up to the 60-minute moving average, but the pullback is so deep that it's more likely we're in a trading range. The top of the range might be above this high. The bottom of the range might be below this low, but it's likely that for the next couple of hours we're sideways. So it looks like not a lot of bulls exited at the midpoint of their two buys. So that means there are a lot of bulls who believe we're getting back up here. For the bears to short, they need a pretty good looking bear bar. So, pretty good looking bear bar, decent sized bear body closing near its low. You look at that and you say, oh gosh, it's disappointing. I was hoping we'd get a gap above 19 and look for a measured move. But big up, big down creates big confusion. And when traders are confused, they only want to buy low, they want to sell high, and they want to take quick profits. They don't want to buy high. They don't want to sell low. And they stop swing trading. So we're probably in a trading range. This could end up as a triangle, lower high, higher low, and then more sideways over the next couple hours. But probably sideways for at least a couple hours, possibly all day. And if we do break out up or down, we're probably not going to go very far either way. So we may go up a little bit more, may go down a little bit more. But today's probably going to be mostly a trading range for the remainder of the day. What happens if we start doing this again? Well, then I'll change my mind. What happens if we get another series that looks like that? Then I'll change my mind on the downside. But right now, 60% chance in a trading range for at least a couple hours. For the bears, a lower high major trend reversal. It's a wedge on a smaller time frame. We're up on 16, down on 17, and then up and down and up. Now let's look at a 1 minute chart. So 3 legs up, 1 pullback, 2 pullback, 3. Probably we'll get a couple legs down. This is a 1 minute chart, but that's so bullish, it's unlikely we're going to go straight down. Confusion, big reversals, lots of reversals. You don't know where the market's going to go. Disappointment, you get a big bear bar, 20, it reverses up. You get a big bull bar, 21, it reverses down. Those are the 2 hallmarks of a trading range. So what about selling below 22? I think if you can use a wide stop, you can do it. So if you sell below 22, maybe you put your initial stop above 22. I probably would put it way up here. That means trade small. If it goes up, you can sell more. Right now, it looks like a good-looking bear bar, but we still have 15 seconds remaining. And it may not look so bearish when it closes. Another thing that happens with trading range trading, good-looking bars become less good-looking in the final minute or so, like here. So nobody's going to sell below 22, despite a wedge rally to a lower high double top. That's a bad sell signal bar. If 23, if 23 is a bear bar closing near its low, traders might sell below that, but nobody's going to sell below 22. It's going down. Who's selling? Bulls. Bulls who were hoping it was going to get to the 12 close are deciding to get out, break even between their 2 buys at that pink line. Remember, 60% chance we're going to get to the 12 close before the end of the day. If we trend down strongly, then no longer 60%. But at this minute, 60% chance we're going to get up there by the end of the day. Here, it took 3 hours to get back to that close, but the market did get there. Very strong rally by the close. Wait for a bull bar closing near its high to buy more. What about this? Well, you want the second buy to be at least twice the size of a scalp below the first bar. So you buy more here, and the average price is right there, and you can see we just went barely above that midpoint. And the bulls have bought that close and bought more, 1 tick above that. They get off break even. Another example, got down below the bottom of the buy climax, and at the end of the day, we got back to that close. Strong rally, down and then down. A couple hours later, back to that close. Later in the day, we got a big reversal down. By the close rally, bears disappointed, but the bulls disappointed by that bear bar, but a lot of them decided to try to get out around break even. they placed a limit order around the close of that bull bar, and they got close to their order. So some of them get out, and then the others looked at this and said, "Uh-oh, micro double top. I'm going to sell below that bar or below this bar, the neckline of the micro double top, expecting more of a pullback." Bulls buying below of 22, looking for at least a third leg up. We have 3 legs up on 16, and then down, up, and down, up. So we have a wedge, but 18 was strong enough, 18, 19, so it could start the count over again. So it would be 1 pullback, 2 pullback, 3. Plus we have that magnet here, and we have all these other magnets as well. The measured move based upon yesterday's sell climax, the bottom of the sell climax, the top of the sell climax, that pink line. We have yesterday's high, that red line. We have the 60-minute moving average there. We have last week's low. We poked above last week's low and sold off on the weekly chart here. We broke below last week's low, and we're right around last week's low. The bulls are trying to get above last week's low. There's another target, but I don't have to draw it in here. I'll throw up a 15-minute chart and I'll draw it in. I know that we'll get there, but I'll put it in anyway. Today's Friday, and we're probably not going to close at the low of the week. We're not going to close at the high of the week. And when the market's not going to close at the high or the low of the week, what it often will do is try to close in the middle of the week. And this is the high of the week. That's the low of the week. And this is the midpoint of the week. And so that is another magnet. Let me go back to the 5-minute chart. It's another magnet in that same cluster of magnets. And that's just another reason why the market probably is going to try to get up here at some point today. A high one buy, so a bull trend, a pullback, but a doji bar near the top of a trading range. You only buy that if you can use a wide stop, scale in, and be patient. Even though I think we're going to that close, and we're so close to those other magnets, I think we're probably going up here. Can you buy above 23 for a swing? Buy above 23, and then look for a 20-point move up to here? Yeah, I would not. I think we're in a trading range, and I think it's better to scalp. And a lot of the scalping is with limit orders. You buy the low of 19, you buy the low of 22, and you don't want to be buying with stops too high up, especially when we're getting a lot of sideways overlapping bars, 4 bars here, and then 4 bars here. Small tight trading ranges, not good for stop order traders. Bull low double bottom, 16 and 7. But this sell-off is deep enough to create a lot of confusion, and it makes it more likely that we're not going to go up here. And then this rally, up and down, up and down, up and down, up. So, I think we're going to go a little higher. I do not think we're going to go a lot higher. I think we're probably going to be in a trading range for at least a couple hours. So if the range started around bar 12, 13, so at least until bar 36, I think we'll be mostly sideways. The range might be small up here. It may come all the way back down here again. One of the reasons why it might not come down here again is seller closed bears 15, disappointed 16, were able to get out, break even 17 or 18. So there's less reason to come back down here. We've already tested the 15 close. We've tested the buy climax low. We tested the moving average several times, but we have not tested the 12 close. That's why I think we're going to go at least a little bit higher. It's not a buy the close rally. It's a buy the pullback type of rally. So I would not buy up here. A lot of bulls will be scalping. So the bulls have bought the 20 too low, get their 5 points, and they'll sell. the bulls who bought the 12 close and who sat through all of this, they will sell around here. There are other bulls who bought here thinking we'd reach all of these magnets. They're going to sell up here as well. So the bulls need a strong breakout above all of this if we're going to go a lot higher, and chances are it's not going to happen. Okay, I'm going to step aside. I hope you all have a good day.